The multi-year IPO drought has ended. U.S. public markets are seeing a sudden surge of new listings as companies specializing in AI, crypto infrastructure, and enterprise software move to the exchanges. This creates an immediate psychological hook. When high-growth brands debut, the pressure to buy in the initial hours is intense. Retail demand often drives an aggressive opening spike as investors chase the day-one pop. Mathematical reality usually sets in within a few months. Once the lockup period expires, early insiders and employees are legally allowed to sell their shares. This flood of supply frequently drags the stock down to a lower, earnings-based baseline. Early-stage public companies offer asymmetric growth, but buying during the opening hours often means entering a valuation trap. These debuts are frequently structured to provide an exit for venture capitalists, rather than a fair entry for the public. 6 companies define the 2026 narrative: CoreWeave and Cerebras in AI infrastructure, Circle in digital finance, Figma in design software, Klarna and Chime in consumer banking. Each company presents a story about a technological revolution. However, the practice of running these businesses involves heavy capital expenditures and unproven paths to profitability that often clash with those optimistic narratives. To find a de-risked entry point, we have to separate the underlying business fundamentals from the marketing engine used to sell the IPO. Technological breakthroughs only become smart investments once the financial fundamentals support the valuation. A compelling story does not guarantee a sound return. We begin with AI infrastructure. This sector focuses on the physical backend, the heavy metal, data centers, and specialized hardware required to power modern intelligence. CoreWeave provides high-performance GPU cloud computing, while Cerebras develops custom AI hardware to challenge the industry leaders. These companies offer direct exposure to massive corporate AI spending. They allow investors to bet on the build-out phase without relying on individual consumer software adoption. High capital intensity is the primary structural risk. Building and maintaining this infrastructure requires a continuous drain on cash. These firms must constantly purchase expensive GPUs and build new data centers. If competition increases or growth slows, profit margins come under immediate, severe pressure. AI infrastructure represents a high-reward, high-burn play. Success for these thematic investors depends entirely on whether the companies can protect their margins as they scale. Circle operates USDC, a stablecoin designed to facilitate global payments and digital dollar settlements. The growth narrative focuses on capturing a larger share of global digital dollar adoption as on-chain trading volumes expand. Structurally, the business depends on the interest income generated by its reserves. This makes Circle's revenue highly sensitive to interest rate fluctuations and federal regulatory shifts. Circle functions as digital money infrastructure. Its long-term viability is tethered to macroeconomic policy rather than the speculative volatility of the broader crypto market. In the software-as-a-service sector, Figma serves as the primary ecosystem for UI design and collaborative product building. Figma benefits from high-retention SaaS economics. Once an enterprise integrates the platform into its workflow, it generates a very sticky, recurring revenue stream. High-retention software often enters the market at peak valuation multiples. Additionally, the rise of generative AI could alter design workflows, forcing Figma to defend its market position against new automated tools. While the product stickiness is proven, overpaying for peak SaaS valuations leaves investors vulnerable to significant stock corrections if growth metrics slip. The consumer tech shift is led by Klarna's Buy Now, Pay Later model and Chime's digital-first neo-banking platform. They're targeting a generational move away from traditional banking toward flexible, mobile-first financial services. Both businesses are extremely sensitive to consumer credit risk. Profitability depends on the ability of their users to avoid loan defaults during economic downturns. High interest rates increase the cost of capital for these firms while putting more pressure on their customers. This environment acts as a direct multiplier on credit risk. Consumer finance stocks are inherently volatile. They require clear evidence of credit quality before an investment can be considered de-risked. To navigate these IPOs, we use a strict defensive filter. First, verify the revenue growth. You need to see hard performance data that matches the public hype. Second, demand a proven path to profitability. Avoid companies that rely on perpetual cash burning to sustain their expansion. Third, check the valuation. Determine if the stock price is mathematically tethered to actual earnings or if it's priced for a perfect scenario. Fourth, assess the competition. Consider if entrenched tech giants have the capital to replicate the core business and squeeze the newcomers' margins. Fifth, watch the lockup expiration. On day 180, a sudden flood of shares often enters the market as early investors sell their positions. Waiting out this window shields your capital from the price drop, allowing entry after supply and demand stabilize. Applying these 5 filters ensures you aren't acting as the exit liquidity for the venture capitalists who funded the company's private growth. Your strategy should match your goals. Thematic strategists interested in AI or crypto infrastructure should keep CoreWeave, Cerebras, and Circle strictly on a watch list for now. Monitor at least 2 quarterly earnings reports. Use that data to verify if their business modes can actually withstand competition from big tech. Cautious fundamental investors looking at Figma should wait for software valuation multiples to compress. Patience often leads to a more rational entry price. For the risk-averse, Klarna and Chime should be avoided until macroeconomic indicators show that consumer default rates are stable and manageable. Effective investing requires aligning the specific structural risks of these sectors with your personal risk tolerance. The 2026 IPO cohort presents a recurring trade-off: the psychological comfort of early momentum versus the mathematical reality of potential overvaluation. We use the IPO waiting room to manage this risk. Those unchecked boxes remind us to prioritize patience over participation until the data supports an entry. Strategic investors trade the excitement of day one trading for the advantage of a de-risked, stabilized price. The most successful public market investors wait for a true valuation to emerge, bypassing the initial volatility of the debut.